G'day folks, welcome back to another update for the S&P 500 and the NASDAQ. Now the prices have been stagnating up there for a while. Is this possible bearish downturn? We'll wait and see. Before we go any further, make sure you hit that like and subscribe button to support the channel. Now in terms of the outlook for the S&P and the NASDAQ, the valuation, the S&P 500's forward price earnings ratio stands at 21.9, surpassing its 10-year average, indicating elevated valuations. In terms of sector composition, information technology, financials, healthcare and consumer discretionary sectors dominate the S&P 500, collectively accounting for 68% of its composition. In terms of earnings performance, a significant proportion of the S&P 500 companies have reported earnings that exceed expectations, reflecting robust corporate profitability. For market concentration, the top 10 stocks in the S&P 500 now represent 39% of the index's weight, underscoring a high level of market concentration. And recent market movements, the NASDAQ has recently experienced gains driven by strong performances in technology stocks, particularly those involved in artificial intelligence. So first looking at the S&P, we'll look at the monthly, the weekly and the daily. We always look at the long-term trends first. And we've got here, and for those new to the channel, with the moving averages here on the CCI and the price chart, and they can be found in the description below if you want to learn how to draw those. But here we've got the on the monthly, you can see there's been a nice and strong bullish run since around about June 2023. Had a bit of a dip here, but it looks like it may be having another retrace in the near term. We did draw these Fibonacci retracements, divergence I should say, based on the divergence. We had almost a double top here on the CCI versus a pretty steep higher highs on the price on that first divergent. You can see there it pulled back, and the way we measure that, this is on the monthly chart, we draw a Fibonacci from that peak and we take it back to the previous low before that divergence started. So the divergence started there, so we take to that significant low, and you can see there the first retrace happened in that 38% level of the Fibonacci. That's a minimum level it hits more than 90% of the time. In this case, it bounced beautifully out of it. I don't trade these divergences. I use them as a potential area to either avoid trading or very cautiously trade. Now this is a monthly, so it's a very long-term trend on the, or divergence I should say. Now I've got another divergence here happening. You can see there from that point there to there on the CCI, lower highs versus higher highs on the price. And if to draw a Fibonacci from there, assuming it starts pulling back from there, you can see that I've already drawn a target area, that 38% level indicated by that rectangle. So that's the minimum level of retrace if it should start retracing from there. Of course, it could keep going higher, in which case we have to realign the Fibonacci and raise the target area. So as long as that CCI keeps dropping and the price keeps rising, that's a bearish divergence. So that's the methodology on the divergence. That's a monthly. Notice here as well, we've got a weekly divergence as well. I won't draw the Fibonacci's, but you can see here I've highlighted in rectangles the minimum target range, and both of those have been hit. Now since then the prices are appreciated and reached almost a double top up there. But notice the CCI on the weekly is still dropping, so weakening potential on the weekly. On the daily, you can see there we had a smaller range divergence, and these divergences, by the way, on different time frames are independent. We had a pullback, hit this minimum target range, it fell further. This one would have gone around about the 50 or 61% Fibonacci. Just to show that where it did actually fall, we take it back to that level. You can see there 38% was penetrated quite easily. And it dropped down to the 61%. In fact, it went lower than that at that point there before bouncing and hitting that resistance again. So again, on the daily, we've got, you could argue that's a bearish divergence as well. And that looks like it's already hit that retrace. You can see there just with eyeballing it, that's about the 50% level. That's almost a double top on the price, slightly lower highs on the CCI. So again, that's on the daily. Now if we go to the intraday charts, if you're trading on the intraday, we go in the direction of the daily trend. So your first short entry would have been on that candle there. Now where that happens to be on the hourly, that was on the 2nd of February. So if we go back to the 2nd of February, that was the weekend, the Friday, and it opened up here on the 3rd of February, on the Monday. So that would have been your first level of going short, and you would have got out. That would have been a small loss. You would have got out there when that CCI hits that moving average range. So you would have got in there and got out on that one there. Actually, no, I'm wrong. You would have got out on that one. So let's draw measurement tool. So you would have got on the close of that candle. That was the Monday on that hour. And you would have got out on that candle there. So that would have gained you 0.27% gain in 7 hours of trade. A very small trade, but nonetheless a profitable one. You would have avoided going long during this period because remember we're going short in the direction of the daily. And you would have entered the next level, short entry. Now you can enter these when it's in the moving average range, but you've got to be careful because sometimes they just bounce in here, then bounce out again. I like to go short when it breaks below the price and the moving average. Now in this example, you would have lost that trade because that closed out on that one there. Would have been about a break even, 0.16% loss with a 3 hour of trade. And more recently, you wait for this to break below the moving average band of the price chart and you go short. So a potential short entry here. One thing I should have mentioned as well is if I zoom out, you can see here on the daily, I've drawn this descending diagonal trend line, and that aligns with this on the hourly chart as well. You can see there the price has been gravitating towards this descending trend line for a number of months now, and it's still doing so on the hourly as well. So just be mindful of that. We may see further declines back towards this trend line, so just be aware of that. And that could be the start of a further decline, as I said, with that. As soon as that breaks below that moving average, further declines to the downside. So the NASDAQ has got a similar sort of pattern. We're on the monthly. We've got a bearish divergence, a very strong one. And you can see there, that's extended. Move it out to that CCI. And that's to the recent high there as well on the monthly. So a bearish divergence on the monthly. Again, I haven't drawn a Fibonacci retracement yet. I'd like to see this break towards and below this moving average to be more confident of a break to the downside. That's the monthly. On the weekly, we've got another bearish divergence, lower highs in the CCI versus higher highs in the price. This one has actually hit and penetrated that 23-38% level with those candles. So it's already hit that range. It bounced a bit. Now this could actually fall further. The CCI is still dropping, so be careful about going long at this point. And on the daily, if I zoom in, again, it's got this diagonal trend line similar to the S&P, and it's gravitating towards this diagonal trend line. Also, we've had this previous bearish divergence versus high highs in the price, hit our minimum target range. And it looks like now the NASDAQ has actually broken into that moving average range of the CCI, giving us a neutral positioning. So don't go long or short on the intraday if you're trading on the intraday. So we go to the intraday charts now. So again, avoid trading long or short until we see a more decisive break above or below this moving average range. But you can see there, had you gone short on this one, this is similar to the S&P, you would have probably made a small gain on that one. I won't draw the lines, but you can see there by eyeballing it, getting in there and getting out there, similar to the S&P. Avoid going long, and similarly, that would have been a very poor trade on that one. So again, they're not bulletproof, but we're talking about probabilities here. Always go in the direction of the higher time frame. Back there, for example, on the 17th of January, you would have done quite nicely going, taking some long trades during this period when it was moving up. But also when you're dropping, like you notice back here, you would have taken a short trade back there on the 27th of January. Actually, no, that would have been a bit premature to go into that one. So again, sometimes you can luck out and miss the trade. That one would have been a bit too early. Again, I'd like to avoid trading within the band, because you can see there, for example, when sometimes it breaks in there, you think it's going to go higher, but then it drops down. Breaks in, drops down. In this case, it broke through the band to the top side, and you would have taken long positions on that one on the intraday. So always take the direction of the daily, but wait for it to break above or below the moving average band. At the moment, again, don't take long or short trades because of the daily, but at the moment it's breaking to the downside on the hourly, but notice the price is still above the moving average range, so I'd like to see that break below, and also by that stage you should probably see it break below on the daily as well. To support the channel more, hit that like and subscribe button and share the video. For added benefits and the cost of a coffee, consider subscribing to the Patreon page, where we look at weekly scans of bullish trending shares and insider trades that may have occurred. Thanks again, and see you in the next video.